What is commercial real estate? What is a syndication? What is a multifamily? How money's made in multifamily? They said, hey, if you're putting your money in it, we're going to put our money in it. They saw the amount of detail we take in terms of vetting sponsors and vetting markets and picking the right deals. And that's kind of why they wanted to swim, or fly alongside us, basically, in a lot of those deals.
Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise podcast listeners. Thank you again for jumping into yet another episode of On the Rise. I've got another amazing guest with me, as I always do. I've got B Dwiek. B, welcome to the show.
Thank you. Appreciate it being on your show, and I'm an avid listener, actually.
Thank you. Well, we appreciate your loyalty there. I actually had somebody a couple weeks ago tell me that they binge listened to 100 episodes. I can only imagine the sacrifice that took, and hopefully they had it on 2.5x speed to crank through that much volume. But really have looking forward to this conversation with you. You and I come from very I would say similar paths and journeys, and just before we kind of get into some of the heart of the questions or topics here, we'd love for you to tell our listening audience a little bit more about yourself, your own personal kind of journey, into the real estate space, what you're focused on today, et cetera.
Yeah, no, absolutely. Thanks, Jeremy. Like I said, I pretty much started my life as an electrical computer engineer. I'll give you the quick 2-minute synopsis of that. From that, I became a chip designer. I worked at IBM, and on my first day on the job, my manager was like, hey, where are you living now? Because I had to relocate. I said I rented an apartment. He's like, no, you should buy a house and rent out rooms. Few months into it, I became a landlord, an accidental landlord living with my tenants. And that was in the mid 90s, when house hacking was still not an official thing on YouTube. Fast forward, I just continued my tech career. I was always the guy that bought property. It just made sense for me. I would say a lot of people in my family are into real estate, and it's just been like one of those things that take some money that you don't need and put it away in real estate. It wasn't until I moved to the Bay Area in 2006 to continue my tech career, and in 2009 was really the golden opportunity. Even though it didn't feel like a golden opportunity, everybody was freaking out about real estate. But for me, it was like, wow, there's really some great buys here. And that's where I started buying a lot more real estate and getting into like short sales and more sophisticated things. And I didn't get into passive investing till 2017. That journey mainly started when I just started to have too much headaches having to have multiple properties and tenants. And as you know, as a guy working in tech full time, having to deal with tenants after work, not a fun thing to do. And that's kind of how it really the journey started in terms of passive investing. Up until 2019, when I decided to exit out of tech, I built enough passive income where I was like, okay, I'm going to become a full-time real estate person. And that's kind of where the journey 2.0 started.
Yeah, no, that's great. I appreciate that. And a lot of our listeners know what my, kind of background is, in the real estate space. But, one of the main drivers, for me to get involved in real estate, kind of in the aftermath of the global financial crisis is obviously there was a lot of blood in the streets. We wanted to take advantage of that. But at the second, side of that is we just had a passion and a love for real estate, in investing, and started fixing and flipping homes because that looked super sexy on HGTV, and we wanted to kind of try our hand at it. But I, like you, got to a point. It sounds like you reached that point in 2017. I reached the point in 2015 where I honestly, for bandwidth reasons, I had to get off one of the horses I was riding, set that, horse out to pasture, because quite frankly, I was struggling with bandwidth, having two kind of active full-time jobs, one in the tech space and two, now in active real estate ownership. So I also, like you, pivoted to passive. So, I'd love to kind of also have you maybe tell our listeners a little bit more about, this gap that you saw, in the marketplace today that led you to find or found, I should say, Bluestone Flagship Investments. Was there maybe a gap out there, with investors that, just were unfamiliar with the benefits of passive real estate investing in the alternative space?
Yeah, so the Bluestone part of the journey kind of came in as I got into a full-time investor in real estate, and it was mainly my own capital. Me and my partner, we met into the commercial real estate training, and we actually started buying distress QSR, just like the one you see behind me here. Quick service restaurants, the drive-throughs, and we buy them vacant, they're distressed, and we put back a tenant in them, we stabilize them, and then either use the tenant as an exit strategy, sell it back to them, or actually sell the property while the tenant is in it. As we wanted to get more deals and bigger deals, it just became challenging from a capital standpoint. So we started bringing in partners. And when we did the first deal, second deal, and they started seeing that kind of return we were getting on those things were, immense. They're like, hey, what's the next deal? What's the next deal? Say, hey, I don't have enough active deals for you, but if you're interested, I am investing in these passive deals. And as you know, from 2017 to 2019, the market was just amazing in syndications and so forth. We were making significant amount of return. Deals were churning every 2 years almost, or 2.5 years. That's when we started basically getting more investors involved because we didn't have enough deals to deploy their capital. And he said, hey, let's vet the deals that I'm going to deploy our money in it, and then open it up for you guys to actually invest in. So that was really kind of the set where we figured out how to structure the proper entity, how to structure the right way of getting investors into deals. And honestly, it took a bit of education to educate them what is commercial real estate, what is a syndication, what is a multifamily, how money's made in multifamily. But over time, it just became second nature for them, where they said, hey, if you're putting your money in it, we're going to put our money in it. And, a lot of them were busy professionals in tech. They didn't have a lot of the know-how, but they saw the amount of detail we take in terms of vetting sponsors and vetting markets and picking the right deals. And that's kind of why they wanted to swim, or fly alongside us, basically, in a lot of those deals. So that has been kind of the journey that really kicked off Bluestone to start with, mainly in commercial real estate. Later on, we expanded beyond commercial real estate, and that's really kind of the beauty about having something like Bluestone.
Yeah, no, that makes sense, and I appreciate that. And I do have a question that may be a podcast session of its own, but the question is really centered around, how do you evaluate deals? Because I see hundreds of deals, come across my email feed every single month, right? How is it that BD evaluates deals? And second to that, maybe a part B to that, is that are you leveraging AI to evaluate one deal from another?
Yeah, well, that's a great question, Jeremy. And let's just start that. The principles are always the same. Typically, you want to start with a sponsor, which is typically what markets they play in, how long they've been there, what their experience level, and that for us takes about 50% of the weight in the decision making is the sponsor. The next level is the market. And that's actually these first 2 points a lot of investors miss because they see a PowerPoint with an investment opportunity. Wow, they chase the yield, and then later they have to actually deal with the mess. So the second is the market. We dive into like which markets we want to invest in, which market we not want to invest in. Investing in multifamily in Dallas is very different than investing in multifamily in Cincinnati. And again, so you really need to understand the submarket, and then the asset class, everything else within that submarket. And then the third part is the deal itself, the underwriting for the deal, the legal documentation, and so forth. And just to understand that, is this deal structured in a way that mitigate risks? What is the sponsor doing to minimize those risks? What are those risks? And then what's a best case scenario? What's a worst case scenario? And what's a likely scenario for the deal? So a lot of times, once we've done through the due diligence, we actually recreate what we think the likely return for the investors are, saying, hey, the presentation says this, but we think it's going to be likely from this range to that range. But over time, because we started getting an inflood of deals, it became very difficult for us to keep churning, because it would take us honestly about 2 weeks to do a full-fledged due diligence on a deal. So we said, okay, what type of screener can we put in order to say yay or nay? So we actually came up with a very systematic way, used a very common engineering concept, actually, where you actually have criteria and weights. And you multiply the criteria and you grade each one of the criteria, and you multiply by the weights, which is like a risk analysis criteria, typically for failure analysis. I don't know if you dealt much with failure analysis in tech. And then you multiply those numbers, and eventually you get a number count. It tells, and we're like, hey, anything over this number, if a deal scores over that level, we're going to look at it. If a deal doesn't score over that level, we're just going to pass. So that was like our first screener. And then as ChatGPT came in, and you can actually start programming the machines to do a lot of that early on screening for you, we started implementing that. So now we actually have a custom GPT that we can very quickly upload the deal into it, and it very quickly spits out the key parameters that we're interested in. And for us, it's like the yay or nay. Definitely it has to be a sponsor that we like to work with, a sponsor that we vetted the deal with, and so forth. But the deal does take that aspect of the sponsor within the metrics that it gives. But very quickly it could tell us something we want to double click on or something we want to pass on. And that has a huge value for sponsors, because they respect our relationship now. They're always giving us early access, early look in deals before they come in. And sometimes even when they're about to write a contract, to put a property under contract, they say, hey, would you consider investing in something like this? They don't even have an offering yet. They would just send us literally the OAM on a property they want to put under contract, just to sense if that's something that we would consider or not consider.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
It's so fascinating that, now we're able to tap into and harness the power, of AI, in evaluating deals and assigning kind of, risk factors to different, deals and opportunities. I do think about kind of some of those things that I think maybe AI doesn't always get right, or it can't necessarily screen for. And that is, really what I call the three main risk factors, right? The operation risk, the execution of the business plan risk, and then of course the market risk, which oftentimes we don't even know what that next market risk is going to be, because we're not sure what that next maybe headwind is going to be, or that next black swan event, if that makes sense.
Absolutely. But that's also could be mitigated. I think in most real estate deals, if you buy right, a lot of things could be mitigated. Yes, the plan might not go to plan according to the plan if the market takes a downturn or the interest rate goes up 3 points, or for sure. But if you're coming in at a good cost basis, you're likely to be able to kind of sail the ship to harbor without really losing too many people on board. And you're right. You're right. It's very difficult to do the execution, but that's really where, like, knowing the sponsor, knowing how they run their operation, knowing how they're expert in their field. We've had situation where we had sponsors enter a new market. We typically sat on the sideline to mainly see how well they're going to operate in that market, how well they're going to build their team. And when they get to the point where they have enough momentum in that new market, even though they're great in one market, but that's a newer market for them, they still need to build the substance and everything else. This is when we started taking the deals in that newer submarket a little bit more seriously from that sponsor.
Yeah, makes sense. So let's talk to our tech. Let's talk to our tech friends. I know you got a lot of tech friends. I've got a lot of tech friends. What are some of the most common mistakes that you see, your busy tech professionals making when trying to invest passively?
I think we invest passively in more than just real estate. We invest in startup, in seed, we invest in debt, we invest in private equity, a whole lot of different things. But if we just narrow it down on the real estate or maybe just investment philosophy is a lot of people do not really know how to kind of benchmark one deal versus the other, don't really have a good idea about how much capital they should deploy in one deal versus the other, don't understand as much that, hey, should I deploy capital from my cash or should I deploy capital from my retirement? And a lot of it is just like not sufficient understanding of their taxes, where they are, how does this certain things help them in a tax, how certain things doesn't help them in a tax. A lot of time they might hear a podcast somewhere and what got said on the podcast is not necessarily applicable for them, but until they understand that from their CPA, what's applicable versus what's not applicable, it's good. So it's good for them to really understand what they're investing in, what's the thesis, what's the downside risk, but at the end of the day, what's their net return after tax? Because that would help them really decide, is this investment best done with my cash, where I'm going to get the benefit of the depreciation, or I'm not really getting much the benefit of the depreciation, I'm better off do it for my retirement. And if I do it for my retirement, is there a way I can maybe convert some of my retirement into Roth to actually get the next level benefit there? The key problem I typically see all the time is chasing yield. That I would say is always like, people get really attracted to any offering that has a very high yield return, and they try to use that as a metric of, oh, this deal is better than that deal. And often they don't realize, well, after enough experience, they realize that what got stated in terms of projected return might not be the case. And that's really where we take the time to kind of educate a lot of investors. Is like, just because this is projected at this much and this is projected at that much, and both sponsors says they do, very safe assumptions and very, safe underwriting. At the end of the day, we take the whole deal, we re-underwrite it itself, and we give them what we feel is a more appropriate. And again, our guess is just as good as everybody else's guess, but we tell them that you can't take it two things and expect them they're both the same way. So if I have to leave this listeners here with one thing, I would say, don't just chase yield. Change what's the probability of this sponsor being able to execute this business plan. I think that's a better, safer bet to always, hang your hat on, rather than a percentage ARR or percentage IRR in any deal.
Yeah. Yeah, no, you're spot on there. And I think a lot of investors just don't understand that they're paying a risk premium to invest in a deal that's projecting a higher equity multiple or IRR return projection, and they don't really understand, what that risk premium is, right? And then you kind of brought up the point about, the operations and the execution, and a lot of that, quite frankly, comes down to how effective are the lead sponsors at leading an organization and leading people. What type of culture, what type of vision are they casting, internally, right? Because at the end of the day, most of the time with these large commercial investment opportunities, it's not just two men in a truck. It's an entire team, right? That has to execute the said business plan. And while the senior leader might be able to execute a business plan, they're really relying on an entire team to carry out that mission, so to speak.
Absolutely. I mean, it is so essential, especially in the multifamily when there's so many moving parts and so many moving things. That's why people say, well, how come you don't do your own multifamily? I was like, I do not want to do my own. If I want to invest in anything active, multifamily would be the last one I would. I like to invest in multifamily, but definitely more on the passive side. Because when you understand the amount of things that could go wrong and the amount of operation excellence you have to be to really extract that value, people don't really realize it. And sometimes people get a little bit too tied into what numbers went back in their bank account. I was like, have you visited the actual property that you invested in? Have you actually walked over properties? Have you secretly shopped the property manager? Actually, believe it or not, we do that. We actually go visit the properties that we invest in, especially when we have vertically integrated sponsors, to really see how good their operation is. And we've done it on several occasions, and we saw a very big difference between one or the other, even though, they all show the same kind of numbers. But believe it or not, that's really what makes a good deal work, is when the sponsor say what they plan to do in the deal, say what they committed on doing. So yeah, I cannot tell you how important operation is when it comes to an actual deal. This is not just, hey, I'm going to send money and money come back in the bank. There's a lot more that goes, in the machine to make it's a full business. It's a full-fledged business uh, that you're really investing in.
Yeah, and I'm glad you highlighted the importance of walking the actual property that you actually invested your own hard-earned money into. It's one of the main reasons why we at Rise 48 do local market tours where we invite investors to come along with us for the day and visit some of the properties that they've invested their own money into. Ask us the tough questions. Meet our on-site staff, right? Get a chance to see the execution of the business plan in process itself. So I appreciate that. BD, I also know, just kind of in wrapping up here, I know that you're a volunteer teacher, and helping others, younger than us, learn about money management and investing. And as a father of four, two of them being teenagers, and four of them in just 60 days from now, I'm going to have four teenagers in my house, right? So this is definitely something that's near and dear to my heart. But what are the big lessons that you feel every teenager should understand about wealth at this stage in their lives?
Wow. And I'll tell you, man, I have two teenagers, or my son just about to cross out of the teen, and my daughter's still there, but it's not easy. So best of luck to you for teenager management. That being said, I think teaching financial literacy has to start from home, has to start from the parents. Unfortunately, many parents are not as financially literate as we would like them to be. They have to kind of pursue their own journey. Even with an MBA, I don't think I got enough financial literacy. A lot of my financial literacy was actually going in and educating myself on the various different things. Uh, Going back to the kids, I think starting the kids early, like 8, 9, involve them with money decision, have them understand the value of money, have them understand what it takes to actually earn $10. When my kids were young, and again, kids growing up here in California, in the Bay Area, dual income families, etc., in tech, they get to travel and see different parts of the world, very different. But one thing that we did always is, we went to the food shelter where they actually put some time to understand that what they have is a luxury that their parents are able to provide them, and that's not everybody has it guaranteed. And that's really kind of what struck the whole giving back for me. Once I came to the point where I became job optional and I can dedicate X percentage of my time to donating into a good cause, I thought educating youth was important. It started by educating my young kids about money when they were younger. It definitely came a little bit harder as they started becoming teens, 13, 14, 15. But at least you would hope that the seed that you planted when they're actually 8 or 9, because it's a lot harder to plant the seed when they're 8 or 9 than it would be when they're 13 or 14. But again, it's essential. It definitely help them grow. But I would say have them understand what it's like to earn money. Have them understand, if certain things cost certain amount of value. Have them understand what is it like to actually earn that much money. Give them chores. Have them work. Have them actually earn their money. Open Roth IRAs for them. From the money they earn, and get involved with them. Show them how to trade stock, or get them really involved and open early on. One thing I'll share a story with you. Up until 2 months ago, my son, who just graduated high school, didn't really want to know what he wanted to do actually when he graduates. But he said, I'm going to sign up for a community college and I'll figure out what major later. And then in 2 years, maybe I'll go to a standard, big university, a UC school. It wasn't until this summer I got him linked up with other, I'm going to say slightly older kids, maybe in their 20s. They were actually trading crypto, that he got into trading and stock trading and all that. Even though I try to always teach it to him, he just wasn't listening. And then he comes to me, he's like, Dad, I actually decided to take finance as a major. So I know we always want to expose the kids to money, and I did quite a bit of that. Also, at the same time, find in your network people who are probably halfway between your age and your children's age, to kind of influence them in the right direction. Whether it's financial literacy or whatever it is. But net, it's an essential part. Try to teach them when they're younger, and when they get to the teenage years, try to find somebody a little bit younger than you to help drive some of those values into the kid.
Yeah. I know this all too well, BD. You're speaking my language. So no, definitely appreciate, this conversation, and really appreciate the value that you've brought, the listeners today. Would there be maybe one or two different ways that our group can connect with you if they want to learn more about what you're up to offline?
Sure. I mean, our group is called Bluestone Flagship Investors, and I'm available on LinkedIn, B Dwiek. Always happy to guide investors and push them in the right direction. Sometimes a lot of people say, "How do you transition out of tech?" It took me 10 years to really decide and transition out of tech, but I don't think it should take that long. I mean, if you already have a plan and you know where you're going, and you're consistent with doing it, it should be able to about 5 years, and you're there. At the end of the day, if you can find a method that legally pay less taxes and invest more of those tax dollars into a tax efficient vehicles and have it compound, honestly, it's going to be very life changing for the goals that you're going to go after.
That's great. Well, BD, again, thank you for the value that you brought us.
Thank you, Jeremy.
And listeners, thank you again for jumping into another episode of On the Rise. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.